Dr. Dan Mitchell from the Centre for Freedom and Prosperity. Good to have you back on the Economics Explored podcast.
Glad to be with you, Gene.
Excellent, Dan. Dan, you've been having a great year so far. You've had some excellent columns on your International Liberty blog that I want to chat with you about, but you've also had a big win in the last few days. Your Georgia Bulldogs, they've triumphed over the Alabama Crimson Tide, haven't they? So quite an impressive result. I mean, I don't know anything about US football, but it looks like it's a pretty impressive result based on the score.
Well, it's definitely going to make 2022 good for me, no matter what happens the rest of the year. I'm a passionate fan, and I was at the national championship game Monday night. And even though it was like 10 degrees outside in Indianapolis, it was wonderful inside the stadium where we finally beat our hated nemesis, who had prevailed over us 7 times in a row. So it was long overdue. And I'll be smiling for months, even if politicians in Washington continue to do stupid things.
Okay, very good. Well, we'll chat about some of the stupid things that, in your view, they're stupid things. So I want to explore why you think they're stupid. This idea of this global minimum tax. So you've written some great columns on that. You also wrote a great column that I received this morning. So it's the 13th of January, 2022 here in Australia, and you're still on still the 12th of January in the States. And your latest column is on California's economic suicide, which I thought was great. And so you're talking about the adverse impacts of high taxes there and regulation. So that's highly recommended. The issue I want to chat about today is this issue of the global minimum tax and what you say is the need for global tax competition. So in your column on 3rd of January, you wrote that, in my recent column, so that's your recent column, listing the best and worst news of 2021, I included Joe Biden's global tax cartel as one of the awful things that happened in the past 12 months. It's bad news for workers, consumers, and shareholders that politicians approved a system that will require all nations to have a corporate tax rate of at least 15%. Dan, to start off with, why is this bad news? What's wrong with this 15% global minimum tax proposal?
I start with the view of most public choice economists, which is that governments have a tendency to overtax and overspend because politicians, as well as the various interest groups that attach themselves to politicians, they always want to maximize short-term benefits if they're the interest groups. They want to maximize votes if they're the politicians. And that type of system, I think, is what gave us Greece. And if you look at some of the long-run forecasts in terms of fiscal policy and demographic changes, aging populations, I think what happened in Greece is going to happen in a lot of other countries unless there is some external force that pressures politicians not to overtax and overspend. And historically, especially after the Reagan and Thatcher tax cuts, that external force was tax competition. In other words, the mobility of labor and especially capital was putting pressure on politicians to lower tax rates and not be quite so irresponsible in terms of government spending. Well, politicians, of course, they hate that process. And so they've had the OECD and other international bureaucracies working for decades to try to stamp out tax competition, and they did make some progress, but it was really this global tax cartel that Biden and Treasury Secretary Yellen have been pushing. To me, this is sort of a watershed moment of. I have a cat here bothering me. I hope any viewers don't mind, but this global corporate tax cartel is breaking new ground because, in effect, it's saying that politicians are going to create a cartel, sort of an OPEC for politicians, and any country that commits the horrible sin of not having high tax rates is going to be penalized, subject to financial protectionism, named and shamed. All sorts of things might be happening, and I view this as a very dangerous development, at least for those of us who care about long-run growth and prosperity.
Right. Well, they've been remarkably successful in arranging what you call this global tax cartel. So there are over 130 countries that have signed up for it, if I'm getting that right. And countries that you may not expect have signed it. So, I mean, our country, Australia's signed it. We're a member of the OECD, and I think we're one of the countries that's pushed for it because we think that we're missing out on our fair share of corporate taxation, and we've got to fund our welfare state. We've got to fund all of these spending demands, and so our treasury would be pushing for would be supportive of this sort of thing. But you've also got countries such as Ireland. Ireland signed up for it, and that means that it has to lift. I think I was reading it will have to lift its 12.5% corporate tax rate to 15%. So it had that to be competitive to try and attract particularly high tech companies into Ireland. So this will remove the competitive advantage for Ireland, arguably, and also there are places. I think Cayman's has signed it. Is that right? Cayman Islands, and so that some places traditionally seen as tax havens have signed it.
Well, places like the Cayman Islands and Bermuda don't have much chance since they're British overseas territories. And if London says jump, they're forced to say how high. The case of Ireland is very disappointing. Not only Ireland, but also Hungary, Estonia. There are a few other European Union jurisdictions that one would have hoped would have defended their fiscal sovereignty and their competitive advantage. But when Brussels, and not only Brussels, but Washington are putting a lot of pressure on you, and think about it this way, if you're Ireland, right now, under the current system, the Cayman Islands and Bermuda are very tough competition for you because there's 0% corporate tax rate. So if you're Ireland, you're figuring, well, we have to raise our corporate rate 2.5%. We'll still be a lot better than France and Germany, but we can sabotage some of our competitors who don't have any corporate tax rate at all. So when it comes to politicians, always look sort of behind the story to see what their real motive is, because almost always you'll find something very unseemly. In economics, as you may well know, we call this raising rivals' costs. We see it a lot in antitrust literature. And since we really are talking about a corporate tax cartel by governments, antitrust theory actually has a lot to recommend when trying to figure out the behaviors that are happening here.
Right. Yes. Yeah. I like that point you make there about raising rivals' costs. That's a good one. Yes. So I'll read a statement from the Australian Treasurer. So this is Josh Frydenberg, and this is Josh Frydenberg is in what would be considered a conservative government, although, I mean, no governments have really been conservative, or very few have been conservative during the pandemic. But anyway, it's from the conservative side of politics in Australia. So on 9 October, 136 members of the OECD BEPS, so I think that's base erosion and profit shifting. That's one of their initiatives to prevent what they see as this shifting of profit to low tax jurisdictions to avoid tax by the big multinationals, so companies like Apple. So those members, representing more than 90% of global GDP, agreed to a new tax system to help ensure that multinationals pay their fair share of tax globally and in Australia. This will put a floor on the race to the bottom on corporate tax rates and will support the domestic and global economy. I mean, could it be a good thing for an individual country such as Australia, where we don't really, I mean, there's a commitment here to quite a generous welfare state, and we've introduced a national disability insurance scheme in the last decade or so. So for a country like us, where, I mean, there doesn't seem to be much scope to, as much as economists and Treasury officials would argue there is scope, there doesn't seem any political appetite to reduce the size of government. Isn't this a good thing for a country like Australia to sign up for, Dan?
It might be a good thing for Australia's politicians, but I don't think it's a good idea for Australian taxpayers, for the Australian economy, because the same principles that apply in Australia apply in the United States, apply all over the world. Let's back up for a second and focus on what really matters here.
Okay.
Corporations, businesses do not pay taxes. They collect taxes. But when you're talking about the economic incidence of those taxes, not to sound like a boring economist,
Mhm.
but you know as well as I know that taxes are borne by workers, consumers, and shareholders. Now, I suppose if you lean to the left, you might say, "Oh, but I bet most of those taxes are borne by shareholders. Shareholders are more likely than average to be rich, so let's go ahead and do this." Well, okay, maybe you're right about the incidence of the tax being borne mostly by shareholders, but what happens when you're therefore reducing investment in the economy? And since every single economic theory, I mean, even Marxism, they all agree that investment is what drives productivity, and productivity is what drives wages. So even if you assume the corporate tax is borne by shareholders, it's still very bad for your domestic economy. And that's true in the United States. It's true in Europe. It's true in China, and it's true in Australia. Now, I, of course, think that a lot of the tax is borne by workers, and not just indirectly through reduced investment, but also just by via the hiring decisions and employment decisions of companies. So I just don't think it's a very good idea. I mean, heck, it's worth noting that the OECD is one of the most pro-tax harmonization bureaucracies, but the research from economists at the OECD say per dollar collected, the corporate income tax is arguably the most damaging tax you could possibly have. So I don't like tax cartels in general. I don't like politicians conspiring against taxpayers, but certainly the worst of the worst in terms of that approach is to create a cartel for higher global corporate tax rates. I just don't think it's a good idea, assuming that you care about the well-being of ordinary people rather than the self-interest of politicians.
Yep, absolutely. That's a good point about the incidence falling on workers. So, in preparing for our conversation, I had a look through some of the public finance textbooks I have. So, I think I looked through Rosen's book and Jonathan Gruber's book. And the incidence, the percentage borne by workers was a lot higher than I thought that was established in the literature. So, I'll put some links in the show notes and I'll put some exact figures. But you're right, it's a much higher fraction than I thought. So I think that is a very good point. Okay. Okay. So Dan, is this essentially the starve the beast argument? I think I first heard that term in the 90s. Was that or was it coming out of the 80s? Was that the idea of the Reagan administration to starve the beast, to cut taxes, and then you're forced to control your expenditure? Is that essentially what you'd be pushing for? So we actually want to minimize the amount of tax, and that forces politicians to be more frugal?
There's no question that among libertarian, conservative-leaning public policy people in the United States, there's been, I wouldn't say 100% agreement with Milton Friedman's proposition that it's always good to cut taxes anywhere, anytime, for any reason. But there's definitely a lot of support for that idea. I don't have the quote exact, so this is just going to be paraphrasing it. But Friedman said something that I do think is definitely correct, which is that in the long run, politicians will spend every penny they collect plus as much additional as they can get away with. So in other words, let's put it in very simple terms. Let's say politically, there's a limit on government deficits of 5% of GDP as a sort of a long run average. Well, if politicians are going to collect, whether it's 25% of GDP in taxes, well, that simply means that they'll spend 30% of GDP in spending. If they're collecting 45% of GDP in taxes, they'll spend 50% of GDP. In other words, 45% financed by taxes, 5% financed by borrowing. And I do think in the long run, that is correct. So I think the starve the beast theory does have some merit. Now, interestingly, since you follow some of the academic literature, there's a famous Romer and Romer study that a lot of people cite to say, oh, no, the starve the beast theory isn't true. But if you actually read the study, they say that the theory doesn't hold because politicians, once they cut taxes, within a couple of years, wind up raising taxes,
Yeah.
which to me is like saying, well, diets don't work because people eventually quit their diet and start overeating again. Well, yes, that's true. So in my mind, what Romer and Romer showed is that starve the beast is good, is credible, not 100% explanatory or anything like that, but does explain a lot, assuming that politicians can somehow have their hands tied so they're not raising taxes at future points. And of course, politicians don't like raising taxes nearly as much as they like raising spending. But if they're forced into a choice to either control spending or to raise taxes to finance spending, they'll definitely try to raise taxes. We're seeing that in Washington right now with Biden's so-called Build Back Better scheme.
Yeah. Good point. I'll have to track down that quote of Friedman's. That's a good one, and also the Roma and Roma study. I'll have a look at that. Yep, I just knew that there was some controversy over whether that starve the beast strategy works or not. But good point about how politicians behave. Traditionally in Australia, what we've usually had as tax cuts is essentially just giving back the bracket creep that occurs when you get extra revenue from people moving up into higher tax brackets, marginal tax brackets, as due to inflation. So that's what traditionally has been we've seen as tax cuts here. So that inflation pushes everyone back up at the higher tax brackets, and it's undone. Okay, so you've described it as a victory for politicians over workers. Yep, I think we've covered that. And you've got this concept of goldfish government. Could you explain what you mean by that, please, Dan?
Goldfish government is my attempt to popularize the inherent insight of public choice economics. I don't know whether this is true in Australia, but in the United States, when you're a kid, it's almost a rite of passage that you get a goldfish as a pet.
Yeah.
And historically, we all sort of learned, oh, don't overfeed your goldfish because goldfish will literally eat themselves to death. Now, I have no idea whether that was actually correct in terms of how goldfish, how much food they eat, but we definitely thought that was true. And I think that's a perfect description of this natural tendency of politicians to overtax and overspend beyond the economy's capacity to withstand it. And so I view goldfish government as what happens when politicians have free rein to pursue their short-run vote maximizing strategies, which is why, as we already discussed, I think it's so important to have some sort of external check on the greed of the political class, and that's the role that tax competition plays.
Right. Okay. Yep. Yeah, that's a good point. Now, I mean, would you be in the minority, Dan, of in terms of commentators in the States on this global tax cartel? Or, I mean, because it looks like most of the sort of the voices they usually go to, like people like Larry Summers. I mean, Larry Summers seems to be supportive of it. Countries have come together to make sure that the global economy can create widely shared prosperity rather than lower tax burdens for those at the top. By providing a more durable and robust revenue base, the new minimum tax will help pay for the sorts of public investments that are fundamental to economic success in all countries. So it looks like this is quite popular. Is there much opposition to it other than from yourself? Or, I mean, you're one of the leading voices in opposition. Are there any others?
There are obviously a lot of people who are free market oriented, low tax oriented, who view this as just a typical cartel-like scheme by politicians to transfer more money from the productive sector of the economy to their own pockets so they can try to buy votes. And by the way, that quote that you just gave, this is what really galls me. The public finance literature is very clear, I think, that government spending above a certain level is very contrary to economic growth, especially since the marginal dollar does not go toward anything that could remotely be considered a public good, and instead it goes to consumption and transfer spending, which is widely regarded as a net negative for the economy. And so when you already have governments consuming with their budgets 40%, 50% of their economy's output. And they're talking about creating tax cartels to finance even bigger government, when the academic literature says that the growth maximizing size of government should be 20% of GDP or below. I actually think it's well below that, but we just don't have any good data points in the modern era of governments that only spend 5 or 10% of GDP. So this notion that you get from the OECD and the IMF and other international bureaucracies, oh, we're collecting more money so we can make necessary investments. To me, there should be at least a tiny effort on their part to justify what marginal additional productive investments allegedly will take place as you give politicians more and more money to spend. So I think it's an incredibly anti-empirical initiative in terms of some of their rhetoric. And then it all comes back to the public choice insights that we've already been talking about. This is politicians doing what Adam Smith said that people in the private sector would do if they could get away with it. And Adam Smith wrote that way back in 1776. And he said, well, the good news is in a competitive marketplace, people in the private sector can't make and enforce cartels. Unfortunately, governments have a lot more power to enforce their cartels because they are the enforcement arm. And so I'm very worried about this, not only because of what it means in terms of higher corporate tax rates that will hurt investment, hurt productivity, and hurt wages, but I worry about the precedent of this. I think that the global corporate tax rate will go up and up and up. We already have governments like France and Argentina and others that are saying, oh, 15% is way too low. And we're going to have a precedent being set here that almost certainly is going to they're now going to talk about applying it to, well, we need personal income tax minimum levels. We need capital gains taxes to have minimum levels. Maybe they'll do the same for wealth taxes and things like this. So I'm very worried, again, in the context where the Western world faces major demographic pressures because they've set up these very irresponsible, poorly designed tax and transfer entitlement programs. There's going to be such enormous pressure for politicians to try to kick the can down the road by raising taxes every other year to try to patch things together. And unfortunately, as taxes go up and up and up, the private economy, the productive economy's ability to finance all those taxes and withstand all those taxes and still have robust job growth and income growth, I think is going to be hurt. So we really are heading toward a Greek world of an ever diminishing private sector being saddled with ever rising fiscal burdens by very short-sighted politicians.
Yeah. Yeah. Just on that, Dan, I mean, have you thought much about what the role of international migration is there? So for the last, I don't know, couple of decades or so, we've had a very high rate of international migration to Australia. That's been, obviously smashed by COVID, that we haven't had any really. But we've been relying on that to boost our working age population, and I suppose that does help kick the can down the road in terms of having to deal with the burden of the aging population. Do you have any views on that? Have you thought about whether that's an option? Because I mean, there are still parts of the world that are growing. You look at in terms of population with favourable demographics, the Middle East, Sub-Saharan Africa, parts of Southeast Asia. I mean, is international migration a solution to that?
International migration can make a difference, but what countries have to look at is, are the people they're bringing in younger than average? That's one very important thing. And then the second thing, which doesn't get discussed nearly enough, are the people you're bringing in going to be net contributors to the productive economy, or will they be net burdens living off the public sector? Now, we have this big fight in the United States because, yes, we get some high-end migration. Lots of professionals from around the world do want to come to the United States, and we have, or at least we had, some special visa categories for investors and things like that. But a lot of our migration is illegal migration coming across our southern border by people with very low skill levels who are disproportionately more likely to be utilizing government rather than contributing to government. Now, if it's all 20-year-olds and most of them will wind up working either legally or illegally in the private sector, so they'll be paying some tax, but if they're in low-end, low-wage jobs, they're probably not going to be big net contributors to the public fisc. Now, if you're, on the other hand, Switzerland, where you have a lot of high-end, highly skilled people from all over Europe, migrating in, then immigration unquestionably is a net plus. Now, I'm not familiar. I know Australia has some sort of point system, so I assume it probably works more rationally than it does in the United States, but I'm not familiar with any studies or research about, is migration, has it been a net fiscal plus for Australia compared to, what it is in Switzerland, what it is in the United States.
Yeah, it's a hard thing to work out, Dan. It depends on the scope of your inquiry, what costs you consider. I guess what benefits, what costs. I mean, one of the issues we've had is that because we've got a few major capital cities, we don't have as many mid-sized cities throughout the country as, say, the United States does, and so everyone sort of wants to come into the capital cities, and that puts a lot of pressure on infrastructure, and also it's pushing up house prices and that sort of thing. So there are a lot of people who argue that we don't want that big Australia. We should cut back on when we do go. When we do have overseas migration again, we don't want to go back to the levels where we had 300,000 people coming in net terms each year. Increasingly there's a view that was too high and it was putting too much pressure on our infrastructure. So look, yeah, it's a difficult calculation to make. If you're just looking at the contribution to the tax system, and that they're probably net taxpayers over their lifetime, because it is biased towards skilled migrants, but then you've got to take into account all those other costs that may have to be paid by government. So it's a difficult thing to estimate. But yeah, good. I thought what you said was really sensible, so that was good. Okay, Dan, just on that, I think we've covered the global minimum tax, and yep, you're right. It's going to result in a lot more tax being paid. It seems the OECD's estimated, where was it? I think it's a $150 billion per annum additional tax could be raised. So, it's certainly going to lead to more taxation being paid. So I think that was great, Dan. Anything more about global minimum tax? I'd also like to ask you about California, your article on California's economic suicide, if you've got time. I thought that was really great. And if you're happy to sort of just summarize what that is, that might be a good way to wrap up.
Okay, well, let me say something first about the global minimum tax. The deal has been struck. Countries have agreed, but there still are some T's to be crossed and I's to be dotted. The Treasury Secretary, Janet Yellen in the United States, basically told Europe, go ahead and do this country by country tax system. She, in effect, encouraged them to adopt systems that would result in much higher tax rates on U.S. multinationals. Now, why did she do that? Shouldn't she be looking out for U.S. multinationals compared to, say, foreign multinationals? Well, she did it in hopes that would then pressure Congress to adopt Joe Biden's tax increase, because Joe Biden's tax increase was going to, in effect, mesh with this new European approach. Well, now it looks like Biden's tax increase, the so-called Build Back Better plan, might not go through. So if that plan doesn't go through, you're looking at U.S. multinationals facing much higher tax burdens coming from European governments, all because of Janet Yellen. So it's something that there are still ways that this thing can blow up. Am I optimistic it will blow up? No, because I think politicians are so determined to try to set this new precedent in place that will enable them to skim more resources from the productive sector of the economy. But it's possible it might blow up. Now, having said that, let's move on to California, because when you talk about governments becoming like Greece, California could just be America's Greece, because what the governor there is talking about, Gavin Newsom, is a tax plan that would be enormous in terms of the relative. California already has a very big public sector. The state is basically run for the benefit of public employee unions, it seems. But what they're talking about here is a massive single-payer government healthcare system financed by a 2.3% gross receipts tax. And what's a gross receipts tax? I don't know if you have that term or that system in Australia, but basically it's just a tax on the revenue of businesses. So you could be a money-losing business, but if you bring in $10 million a year, and even if you've lost $1 million, the government's going to say, we get 2.3% of that $10 million. So it's sort of like an additional sales tax in addition to the sales tax that California ever has, but it's sort of just levied on any monies that come into the business. That's one tax. And by the way, that would be 3 times higher than any gross receipts tax anywhere in America. And by and large, right, left, center, public finance economists think that gross receipts taxes are not very good or efficient or sensible ways of taxing. But then you also have a payroll tax applying on any business with more than 50 employees. And so guess what? If you have 45 employees, are you going to expand? Probably not. But then here's the real kicker. Raising the state's income tax rate, which is already the highest in the country, 13.3%, raising it to a top rate of 18.05. Now, let's think for a second, Gene, why this doesn't make sense. Right next door to California is Nevada with 0 income tax. Just as 2 states to the north, you have Washington State, 0 state income tax. Not to mention Texas, where a lot of high-tech California firms are already moving their operations. Texas, 0 state income tax. Florida, which is aggressively recruiting businesses and entrepreneurs from California, 0% state income tax. Tennessee, where Art Laffer, famous for the Laffer curve, he moved from California to Tennessee, 0% state income tax. So if California is already suffering an outmigration of productive people because of a 13.3% state income tax, imagine what it will be if this plan, which, and Democrats have a supermajority in the state legislature in California, so there's really no obstacle to them pushing this through. And you can save 18% of your income, of your proprietorship income, of your partnership income. There's such huge savings that will be available to entrepreneurs, investors, and business owners if they simply move across the border. So I think this is. I used to say California was committing slow motion economic suicide. This is an absolutely crazy plan in a federal system like the United States, where there's no restriction on moving across borders. It's not as if California can put up a Berlin Wall. And it's not like, the United States government has some very bad exit taxes that make it hard for Americans to move overseas, but there's nothing to stop an American from moving from California to Nevada or Texas. And so perversely, I almost hope this plan goes through, not because I harbor ill will toward the people of California, but I just think about how much fun I'll have writing about it and saying, look, I told you so, because it's really gonna accelerate that exodus of productive people out of California. And it's just baffling that the politicians in Sacramento, the state capital, again, the insight of public choice economics is politicians are short-sighted. Their time horizon is the next election. The productive people, the high-end taxpayers in California, are a small minority, and the politicians figure we'll get votes from the masses by targeting this small group of people. But guess what? Those geese with the golden eggs, they have wings and they can fly away. And if this happens, they will.
Yeah. Wow. I mean, it's extraordinary. I mean, it doesn't seem sensible to try and introduce a single payer healthcare system in a state. That's the sort of thing you'd want to do nationally. Otherwise, you might have people wanting to move there, and they may not necessarily be the most productive people. And so I can see how that's going to increase your costs. So it seems. Yeah, it seems.
And when you say that, Gene, that raises a point I should have mentioned. Vermont, a few years ago, considered a single payer plan, but they backed away for just the reasons you pointed out. The cost would have been enormous. California a few years ago considered it and backed away, but now they're back. And with Democrats having even more ironclad control, they think this time it might go through. Colorado had a referendum, I think it was probably 4 or 5 years ago, a referendum on a single payer system. And Colorado's a blue leaning state now, and they rejected it, I think, by like an 80% margin. So maybe what will happen in California is the politicians will do it, but then there'll be some referendum where the people of the state save themselves from this initiative. But who knows? All I know is if I was an entrepreneur, an inventor, an innovator, a business owner in California, I would right now be looking at the real estate market in Texas because it's not a friendly place to try to create wealth, build jobs, and be in the productive sector of the economy.
Oh, absolutely. And there are so many people who are creators or in the creative economy and entrepreneurs who are moving to places like Texas and Florida. So you've got Tim Ferriss and Ryan Holiday in Texas, and you've got, I think Dave Rubin's just moved to Florida. And I think Ben Shapiro might be there as well. So yeah, lots of people have left California.
And
Ryan,
now I should add one other thing. If you're one of these rich high tech people, and you actually don't have that high of an income, you're in California, you're in that industry because you're getting all these capital gains, but they're unrealized capital gains. So you have a stock portfolio that might be going up from $10,000 to $10 million and stuff like that. Well, for people like that, they can't be taxed until they actually sell their stock. So some people in the high tech industry, will they be insulated from this kind of tax plan? Yes, they probably will be. But guess what? When it's time for them to finally cash out, are they going to stay in California when it's time to realize those capital gains? Almost certainly they'll be moving someplace else. So yes, some people in California will still stay there because it's a great state with a beautiful climate. It's like the climate on your east coast of Australia. There's a
yeah.
lot to be said for California's natural beauty, its climate, its recreational opportunities. It really is a spectacular state, but governed by some spectacularly misguided people. And I just think in the long run, that's creating Greek-like conditions for California's fiscal future.
So as economists, I mean, we could be grateful that you do have so many states with different political makeups in the US that do, it gives us all of these natural experiments, and we can see the impact of different policy settings. So yeah, we'll definitely keep an eye on California. Just before we go, Dan, there were a couple of things. This gross receipt tax, that's not a GST or a value added tax, is it? This is on, it's not as if they're going to be, they won't get back gross receipts tax they pay on goods and services that they buy for their business. Is that, do you know how
Right.
it works?
It's not a value added tax or a GST. There's no credit invoice system. There's no subtraction method system. This is just, if you take in $10 million or $100 million, whatever amount you take in as a business, you have to cough up 2.3% of that to the politicians. So it's an especially bad tax if you're in a low margin industry. Are there some really profitable companies out there, like some of the high tech firms? Yes, but if you're, say, a grocery store or a place like that, I mean, a gross receipts tax is a really, really big burden that you literally have no choice but to pass that on to consumers, and not to mention, workers, because you'll probably be cutting back on your operations. And again, as I said earlier in our discussion, Gene, this is something that if you went to the left-wing public finance experts who believe in higher taxes and bigger governments, they'll be shaking their heads saying, no, don't do it with a gross receipts tax. That's very distortionary, doesn't make sense, doesn't operate in any sort of horizontal equity fashion that at least almost all economists purport to believe in.
Yeah, absolutely. And we had a whole bunch of those in Australia, sales taxes and wholesale sales taxes, and they were all abolished and replaced with a national goods and services tax. I know you're not a great fan of those value-added taxes, but maybe we could chat about that in a future episode. But it was probably better than. The view was that was a better thing to have than all of these what you'd call gross receipt taxes. So yeah, that's what we did in the 90s. What about this exit? You talked about exit taxes from the US. What did you mean by that?
If you're a rich person in the United States and you want to move someplace else, the United States has a regime where, in effect, we shake you down at the border. The simplest way to think about it is, and it goes beyond this, but this is really at its heart what it's all about. If you have unrealized capital gains, even if you don't sell your assets as you move out of the country, the IRS says we're going to treat you as if you have sold those assets, and we want our slice of all those unrealized capital gains. Now, is it as nauseating and noxious and disgusting as the old exit tax regimes that you had in totalitarian systems like the Soviet Union? No, of course not. I don't want to imply that the US is anywhere near that bad, but is it bad policy? Yes, I think it's very bad policy. I believe that emigration is a human right. And you should be able to move if you want to have the benefits of a different country's tax system.
Okay, yeah, that's interesting. As usual, I've learned so much, Dan, from chatting with you, and I've really enjoyed your posts this year, and I'm sure you will continue with strong commentary. And if you're in the audience and listening, then please check out Dan's blog, International Liberty, if you haven't already. Dan, I'm happy to end there, but if there's anything else you want to say, please say it now. Otherwise, we can wrap up.
Well, all I'll say is go Georgia Bulldogs, my national championship. You see the helmet, you see my college license plate there. Again, no matter how many bad things politicians do this year, it's still going to be a good year because we, the Georgia Bulldogs, are the national champions.
Very good. Okay. Well done, Georgia Bulldogs. Okay. Dan Mitchell, the chair of the Center for Freedom and Prosperity. It's been amazing chatting with you. Really enjoyed it. Thanks so much.
Well, thank you, Gene.